Hello, macroeconomics students. We are now quickly approaching the end of the course. We are already 3/4 of the way done, and now we are in week 7, which you'll be reading about chapter 28 and chapter 29. Chapter 28 is looking at the Federal Reserve Bank and a lot of its monetary policy and how it goes about creating money and the money supply. And chapter 29 looking at foreign exchange rates. Just a little bit of the overview for the assignments and things came up this week. I put a forum discussion out there that you'll think you'll find interesting. It's a speech given by our local Kansas City Federal Reserve President, Esther George. So I want you to read her speech and then comment on the question that I asked in the forum discussion. And just again, make sure to jump in early by Wednesday to get that initial post, and then make sure to post to another peer by Friday, and then at least one more follow-up post by another peer by Sunday, and you'll be good. So. Also this week you have a writing assignment, so make sure to look at that. This one's a little bit different, where I asked you to kind of go out and do something in the community, volunteer somehow, or advocate for something in some way. Generally look at this as trying to make this world a better place to do good. It's part of the Avila mission and values. So in fact at Avila we've done a Dear Neighbor Week we have coming up, so we go back to the community and do work in the community. So, pick anything that you're interested in, how you want to advocate for positive change in the world. I know in the writing assignment there could be the potential negative externalities. There's always, if you think anything that could potentially negative happen from a particular action or request that you're taking, I want you to write about that and think about it. But what are the trade-offs? Usually, hopefully, the positives are going to outweigh any costs. So, but you're free to choose anything for that. And if you have any questions about that, do let me know. Now, in regards to the chapter readings this week, with chapter 28, you look at the monetary policy. Right now, our economy appears to be doing well. On Thursday, the jobless claims improved. It was better than predicted. We're still pretty low overall. And the stock markets seem to be doing pretty well. So there's still a question whether the Federal Reserve is going to raise rates later this year. And that's yet to be seen. And that's something I kind of want you to speculate in the forum discussion too. But when they talk about, from a Federal Reserve perspective, macroeconomic policy, there's expansionary macroeconomic policy, which we try to stimulate the economy. That's what's been going on for more than 7 or 8 years now, with the interest rates being at historical lows and just having risen the Fed funds rate back in December. A question whether you think you're going to raise rates again this year. Maybe wait and hold and see how things are going to progress. But they have 3 major tools they can use for expansionary monetary policy. One is that they can lower the discount rate. That's the rate that banks charge, or the Federal Reserve charges banks to borrow. They could also lower the reserve requirement, so that way if there's less reserves, then banks could lend that money back out. And they mostly do what's called open market operations. That is, if they went out and they went and bought securities out in the market from the public, if they're buying it in the market actively, and they do this through the Federal Reserve Bank in New York, then they're going to give money to those individuals. So once individuals have those monies, that increases the money supply. Now, if it was contractionary, they would do the exact opposite. They would sell those short-term bonds, treasury bills, notes, and bonds, and that would pull money out of the economy. Just the same, they could raise reserve requirements or they could raise the discount rate. But they rarely touch reserve requirements or discount rate. It's mostly through open market operations. And the Fed doesn't say that this is now the interest rate. What they do is they start to constrict the money supply, and that causes the price of money to go up, and that's the interest rate. So that's the big question this year, is that Janet Yellen, the Federal Reserve President, will she start slowly raising interest rates to make sure that we keep inflation at bay? But they're being very cautious, and they don't want to have any hiccups, so that's why they're going to take things a little slow right now. So they also mentioned this chapter 2, they mentioned the idea of quantitative easing. That's something after the 2008 crash that the Federal Reserve did a lot more of. And that is, they went out and they purchased a lot of long-term mortgage-backed assets and other long-term securities. And bonds and interest rates have inverse relationships. So if you increase the demand for long-term bonds, that's going to push up the price. And since they pay a fixed coupon, that's going to push the interest rate down. So as price goes up, interest rates goes down. So that's how they were able to keep long-term yields low too. and that was encouraging, long-term home borrowing. So it's kind of the point now. We're hoping that things just are ready to turn around now, but it's still kind of a wait and see. Chapter 29, you're going to look at foreign exchange. I put a link out there in the module for week 7 if you're interested in looking at converting one currency to the other. We primarily look at this chapter from the United States perspective, but for right now, I think it's maybe like it cost $1.12 to buy a euro. The U.S. dollar is getting a lot stronger. Previously, it almost cost like $1.30 to buy a euro. But how you can always find one currency's exchange rate relative to the other is, say that I took one in the numerator and I put that $1.12 at the bottom, I can figure out how much it would cost a European with a euro to buy one American dollar. So now, if one country's currency is appreciating in value, that means that the other country's currency has to be depreciating in value. And in this chapter, it talked about arbitrage, that the foreign exchange market is the largest market in the world, in my opinion. There's people constantly looking for these price discrepancies to try to make profits from. That is, I can buy this one currency, convert it to another currency, and engage in arbitrage and make profit from that. But if markets are efficient, then those prices should adjust immediately and be really hard to make a profit from that because there's so many people watching that. But prices do fluctuate and change all the time, and that's why corporations that deal in international business are concerned about price fluctuations, because most companies want to get paid in their home currency. And if they owe money to another country, they may have to hedge that currency or lock it up some way in some type of derivative, a futures contract, an options, or a money market hedge, so they don't get exposed to currency price changes. Because this chapter looks at, hey, these shifts in demand and supply for currencies can happen all the time. And, right now the American dollar is very strong. There's a strong demand for dollars. In fact, a lot of money is leaving China to come to the United States, and they're buying dollars, and that's what's pushing up the price of the currency. So governments, through their reserves, can kind of try to influence currency prices. Most countries try to go with a system where it's somewhat flexible. They do little intervention. Some countries try to peg their currency, which the Chinese do, but they have to have enough backup currency to go out there to try to create supply and demand changes in the market. So what I want you to think about when you're reading this textbook, whenever you see these supply and demand changes, think of that as the change in the price of that particular currency. So that's it for this week. So I hope you guys do have a great week. Looking forward to seeing you all, or reading your forum post and reading the discussion. But again, we're wrapping up here quickly, so just prepare for the end of the course coming here soon. And if you have any questions, do email me. But take care and have a great week.